The call came at 12:17 in the morning on a Wednesday in October. I was still awake, which is relevant, because I am almost never still awake at 12:17 on a Wednesday. I was at the kitchen table with the laptop open, finishing a quarterly reconciliation I had not had time to complete during business hours, and when my phone lit up with a number I recognized as the branch manager of the Truist Bank where I held my business accounts, I felt the particular quality of stillness that arrives before you understand something you are already beginning to understand. I answered. He said, "Mrs. Ajora Mensah, I apologize for the hour." I said, "What is it?" He said, "Your husband is here. He came in at 11:45. He is asking the night security officer to contact me at home because he says there is an emergency involving your joint account." I said, "I don't have a joint account at this branch." He said, "Yes, that is what I told him." There was a pause. Then he said, "This is the second time this week." I sat at the kitchen table for a moment after the call ended. Outside, Atlanta was doing what Atlanta does at midnight in October, settling into a cool that the day had not prepared you for. Cassius, my Rhodesian Ridgeback mix, had moved to sit beside my chair the way he does when he registers something in the room that he cannot name. I put my hand on his back. I looked at the reconciliation spreadsheet open on the laptop, at the columns of figures I had been building and updating for 3 years. Then I opened a new tab and drafted an email to my attorney, timestamped 12:24 a.m. that read, "He came to the Truist branch tonight, second time this week. I need you first thing tomorrow." Her reply arrived at 6:51 a.m. "I'll have coffee ready. My name is Ajora Mensah Abiodun. I am 42 years old. I grew up in Lithonia, Georgia, the oldest of 3 children. My father was a civil engineer for DeKalb County for 31 years. My mother taught high school chemistry at a public school in Coniers for 24 years and managed the family's finances with the organized precision of someone who understood that a household budget and a chemistry equation have exactly the same requirement. The numbers have to balance, or the whole system fails. She kept a budget ledger, a proper hardcover accounting ledger, the kind with the green-lined pages and the red margin column, in the home office, and every month without exception she updated it. Every category, every dollar, every variance from the prior month noted in the margin with 2 words, above or below. No elaboration, just the fact of whether what had happened matched what had been planned. She said one thing to me about that ledger that I return to more often than any other piece of advice anyone has given me. "Ajora, the ledger does not care about excuses. It only records what happened. Learn to be the kind of person the ledger has no reason to disagree with. I have tried to be that person." On the night of October the 14th, when a man I had been married to for 4 years stood at the door of a bank branch at midnight trying to access money that was not his and had never been his, the ledger, every version of it, agreed with me completely. I graduated from Spelman College in 2002 with a degree in accounting. I then completed a master's in business administration with a concentration in financial management at Clark Atlanta University in 2004. I spent the next 7 years in corporate finance at a large healthcare management company headquartered in Peachtree City, Georgia, advancing through 3 roles: financial analyst, senior financial analyst, and finally a manager-level position overseeing the company's regional budget planning and variance reporting. I was good at it in the specific way that people who have grown up watching their parents keep careful records are good at it, not just technically, but temperamentally. I was comfortable with precision. I did not find the gap between what was projected and what was actual distressing. I found it informative. The gap was always where the real information lived. I left the healthcare company in 2011 to build my own practice. The decision had been forming for 2 years before I acted on it, which meant that by the time I acted, the structure was already in place. The legal entity registered, the business accounts opened, the first client relationship cultivated. I did not resign and then figure it out. I figured it out and then resigned, which is a sequencing distinction that, in retrospect, characterized every significant decision I made in the years that followed. I incorporated Ajora Financial Consulting LLC with the Georgia Secretary of State in February of 2011. I opened a dedicated business checking account at Truist Bank, then still operating under its predecessor name, in the LLC's name in March of 2011, requiring my signature alone for any transaction. I obtained my certified public accountant license, which I had been maintaining since 2005, in good standing. And I secured my first 2 client engagement letters from small business owners in the Atlanta metro area I had been in conversation with for several months. One of them a former colleague, one a referral from my father's professional network, before I handed in my corporate badge. I want to describe the operational structure I built from the first month, because the structure is the story, not the drama that came later. The structure. Every client payment came into the Truist LLC checking account. Every business expense, office supplies from Staples, software subscriptions including QuickBooks Online and DocuSign, the shared workspace membership at a professional carking building in Decatur, was paid from that account. I reconciled the account every Friday afternoon without exception, comparing the QuickBooks register to the Truist Bank statement, categorizing every transaction, and resolving every discrepancy before the weekend. Every quarter, I prepared a P&L statement and a balance sheet for the LLC, formatted the same way each time, filed in a Dropbox folder organized by year and quarter. Every year, I filed the LLC's federal and Georgia state tax returns as a separate legal entity, with a CPA I had retained since 2012. A firm in Decatur called Brennan and Associates, specialists in small business tax and financial planning, distinct from my personal returns. I also maintained a personal budget spreadsheet in Google Sheets from 2011 onward, updated every Sunday without fail, tracking my personal income, personal expenses, and personal savings with the same column structure my mother used in her ledger. Projected, actual, variance. Every personal transaction traceable to a personal Chase checking account held in my name alone. Not $1 from the LLC's Truist account ever touched a personal account except through the formal distribution process. An owner's draw recorded in QuickBooks as a capital distribution, transferred on a documented schedule, and reflected in the annual tax filing. 2 accounts, 2 ledgers. One wall between them, maintained daily, not as a legal strategy, but as the fundamental operational hygiene of a person who had been taught that the numbers have to balance, and that balance requires every dollar to be exactly where it is supposed to be. By the end of 2013, Ajora Financial Consulting had 7 active clients, 2 part-time contractors, and $162,000 in annual revenue. By the end of 2015, I had 12 clients, 1 full-time employee, and annual revenue of $340,000. The Decatur parking space had been replaced by a dedicated office suite on North Decatur Road that I leased in the LLC's name, with a traveler's professional liability insurance policy also in the LLC's name, and an updated operating agreement naming me as sole member, reviewed and amended by my business attorney in January of 2015. I met Kofi Abiodun in the spring of 2016 at a charitable fundraiser hosted by a business association in downtown Atlanta. He worked in commercial insurance sales for a large national firm with a regional office in Buckhead. He was 41 years old, well-presented, and spoke with the easy fluency of someone accustomed to building rapport quickly. He asked about my business within the first 15 minutes of conversation, remembered what I said, and asked a follow-up question 40 minutes later that demonstrated he had been listening. I found that quality, the capacity to actually retain what someone tells you, genuinely compelling. It takes a specific kind of attention, and attention of any kind, applied sincerely, is not easy to manufacture. We dated for 14 months. He knew I had a consulting practice. He knew the name of the LLC. He knew I had an office in Decatur. What he did not know, what there was no occasion or reason to tell him in 14 months of building a relationship, was the precise operational structure of the LLC, the separation between the business accounts and the personal ones, or the details of the quarterly financial statements sitting in the Dropbox folder organized by year. Those were not relationship facts. They were business facts. I have never confused those 2 categories, and the 14 months of our relationship before marriage contained no confusion on that point. We were engaged in August of 2017. We married in March of 2018 at a venue in Stone Mountain. 115 guests. My mother sat in the front row in a deep burgundy dress and wore the expression she always wears at significant events, composed, attentive recording. The first year of the marriage was, in the ways that genuinely matter, what it appeared to be. Kofi was organized in his domestic habits and consistent in his personal commitments. We had an agreement about household finances that I had proposed before the wedding and that he had accepted without objection. We would each contribute a fixed monthly amount to a joint household account at Citizens Trust Bank, a community bank in Atlanta whose history and mission I had respected since my 20s, and all household expenses would be paid from that account. His contribution was $2,500 monthly. Mine, drawn from my personal Chase account funded by LLC distributions, was $3,000 monthly. Everything else, everything outside the joint household account, remained exactly as it had always been. His personal accounts were his. My business accounts were mine. My personal account was mine. The joint account was for the household, and its purpose was the household, and it had no connection to anything else. I drafted a one-page written agreement memorializing this arrangement, and we both signed it in February of 2018, the month before the wedding. I kept a copy in a file I labeled Household Arrangement, March 2018, in the same Dropbox folder where I kept the LLC's quarterly financials. I mention this not because I expected to need it as a legal document. I mention it because that is how I operate. When two parties agree to a financial arrangement, the arrangement is documented. The documentation is not anticipation of conflict. It is respect for clarity. In 2018, during the first year of the marriage, Adjora Financial Consulting crossed $500,000 in annual revenue for the first time. I hired a second full-time employee, a junior accountant named Priya who had just completed her CPA certification, and expanded the office suite on North Decatur Road to include a second private office and a conference room. I moved the LLC's banking relationships to include a second account, a Wells Fargo business savings account designated as an operating reserve, funded by a monthly transfer from the Truist checking account, documented in QuickBooks, separate from both the operating account and any personal account. Every month closed cleanly. Every quarter's P&L matched the prior quarter's projections within 5%. Brennan & Associates filed the LLC's 2018 tax return in April of 2019, showing the company's financials as a fully independent entity with no connection to any joint or personal account other than the documented owner's draw. It was also in 2018 that I began to notice, in the way that someone trained to track variances notices variances, that certain things Kofi said about money did not match what I could observe about his financial behavior. Not dramatically. Not obviously. Small discrepancies of the kind that the ledger registers before the reasoning does. He mentioned a bonus that had not, as far as I could determine from the joint account deposits, materialized. He described a financial commitment he had made to a colleague, as he characterized it, a personal loan of some kind that he mentioned once and did not mention again. He asked in the spring of 2019 whether my business accounts and personal accounts were truly separate, and when I said yes, he asked what that meant in practical terms. I described the structure plainly. The LLC held a Truist operating account and a Wells Fargo reserve account, both in the entity's name, neither connected to any personal or joint account except through the owner's draw. He said, "So the business money is completely separate from our money." I said the business money belongs to the LLC. Our money is the joint account. He said, right, and did not ask again. I noted that conversation in the Google Sheets budget file that Sunday, April 14, 2019. Kay asked about account separation, described structure. He accepted. I noted it not with alarm, but with the same precision I applied to every other entry in that file. A variance noted at the time of observation is useful. A variance remembered later without documentation is an argument. In the fall of 2019, Kofi's professional situation changed. The national insurance firm where he had worked for 11 years underwent a structural reorganization that resulted in the elimination of his division's bonus structure. His base income was unaffected, but the bonus component, which had represented a meaningful share of his annual earnings, was removed. He absorbed this without visible distress in my presence, which I noted as a signal rather than a relief, because the absence of expressed difficulty is not the same as the absence of difficulty. And a person trained to read financial statements knows that what does not appear on the surface almost always appears somewhere else. It appeared in the joint account. In November of 2019, I noticed that Kofi's monthly contribution to the Citizens Trust joint account, $2,500 fixed as agreed, had dropped to $1,800. I raised it directly. He said the short payment was temporary, that he had a cash flow irregularity that would resolve by the end of the month. I said, the agreement is $2,500. He said, I know, it will be right next month. I said, I need it to be right this month. He brought the account to the agreed amount before the end of November. I updated the budget spreadsheet with the notation. NOV 2019, K short by $700, made whole $1,128. That was the first entry of what became, over the following 12 months, a running log of financial irregularities. I did not keep the log because I was building a case. I kept it because I was the kind of person who kept accurate records of what was happening, and what was happening deserved accurate records. December 2019, Kofi's contribution was short by $300, made whole on December 19th. January 2020, contribution on time and in full, no variance. February 2020, contribution short by $900, I raised it. He said the shortfall was connected to a personal financial commitment he had undertaken before the marriage. He described it as an old debt, a private matter, something that would resolve. He did not name the amount or the creditor. I said, Kofi, I need to understand what you mean by a private financial commitment. He said, it's handled. It won't affect the household again. I said, it already has. He said, I mean it won't again. I updated the spreadsheet. I also that evening pulled the Citizens Trust joint account statement for the preceding 6 months and reviewed every transaction. Every outgoing payment was consistent with the household expenses I had been tracking. Nothing irregular on my side. Nothing irregular on the household side. Whatever the shortfall was connected to, it was not coming from the joint account. It was coming from somewhere in his personal finances. I called my mother that Sunday and described what I had been observing. She said 3 things. The first, a man who has old debts he will not name has not finished having them. The second, check that the joint account has not been presented anywhere as collateral, listed on any application, or named in any instrument you did not authorize. The third, call your attorney Monday morning. I called Falek Ademi on Monday morning. Falek had been my business attorney since 2013, retained when I first needed a professional to review client engagement letters and the LLC's operating agreement. Over 7 years, she had become the kind of counsel I consulted not only when something had gone wrong, but when I needed the clearest possible picture of where I stood before anything had. She asked for a description of what I had observed. I gave it to her, including the written agreement about the joint account, the budget spreadsheet notation, and the name of the Citizens Trust branch where the joint account was held. She said, I want you to do 3 things this week. Pull your personal credit report from Experian, TransUnion, and Equifax through annualcreditreport.com. Pull the Citizens Trust joint account statement for the full 2-year history. And send me every document that establishes the LLC's separate account structure, the Truist account agreement, the Wells Fargo account agreement, and the most recent QuickBooks export. I said, I'll have them to you by Wednesday. She said, and Adjora, check whether anyone has attempted to access the Truist account. Talk to your branch manager. I called Gerald Whitmore, the Truist branch manager, on Tuesday morning. He was a branch manager I had known by name and by face for 9 years, a quiet, meticulous man who ran his branch with the operational discipline I recognized and respected. I asked whether there had been any unusual activity on the Adjora Financial Consulting LLC account. He said, no, but he said it in the way that a careful person says no when they are about to add something. He said, I should tell you, we had a gentleman come to the branch 2 Fridays ago. He identified himself as your husband. He said he was authorized to add himself to the account and asked to speak to a manager about the process. I said, what did you tell him? He said, I told him that an LLC account requires the signature of all documented members to make any changes to authorized signatories, and that you as sole member would need to be present and would need to authorize any addition. I said, he's not on the account. He said, I know. That is what I told him. I thanked Gerald Whitmore and ended the call. I sat at my desk for a moment. Then I opened the Google Sheets budget file and made a notation. March 3, 2020. K attempted to add himself to Truist LLC account. Branch manager declined. Reason stated, sole member authorization required. That notation was the 15th entry in what had begun as a record of payment shortfalls and had become something more specific. A documented sequence of a man discovering what I had and moving, incrementally and with increasing directness, toward it. I sent Falek the 3 account documents and the QuickBooks export that Wednesday. She reviewed them and called me Thursday afternoon. She said, the LLC documentation is complete and clean. There is no path from his name to this account through any instrument I can find. I said, he went to the branch and tried to add himself as an authorized signatory. She was quiet for a moment. Then she said, he did not succeed. I said, no. She said, keep the budget log current, and I want you to place a fraud alert with all 3 credit bureaus this week. A fraud alert does not prevent credit activity, but it requires any lender to verify your identity before opening a new account or extending credit in your name. It is free and it takes 15 minutes. Call Experian first. Once a fraud alert is placed with one bureau, federal law requires them to notify the other 2. I called Experian that afternoon and placed the fraud alert. It was active within 24 hours. The subsequent 7 months were a period I can only describe as a sustained dual operation, running the business at full capacity. By mid-2020, we had 16 active clients and were approaching $700,000 in annual revenue, while simultaneously maintaining a vigilance about the financial perimeter that I had not previously needed. I checked the Truist account online every morning. I checked the Wells Fargo Reserve account every Friday. I pulled the Citizens Trust joint account statement monthly and reviewed every line. I updated the Google Sheets log every time anything occurred that required recording. Nothing at the business level was touched. The business operated exactly as it had always operated, and no client ever had any reason to know that anything outside the office on North Decatur Road required my attention. At home, the marriage continued in a form that was functional on the surface and structurally hollow beneath it. Kofi was present. He was not hostile. He was the kind of absent that does not announce itself, the absence of a person still occupying the physical space while their attention is directed entirely elsewhere. I did not know at the time where his attention was directed. I would learn later. In August of 2020, I received a credit monitoring alert from Experian. The alert indicated that someone had attempted to open a new line of credit in my name, a personal loan application through an online lender, and that the fraud alert I had placed in March had triggered a verification requirement. The lender had been unable to complete the verification, and the application had not been processed. I called Experian immediately. The application had been submitted from an IP address that, when I described its geographic location to Falik the following morning, she identified as consistent with a neighborhood in Buckhead where Kofi had been conducting business meetings for several weeks. I did not confront Kofi that day. I documented what I had and I called Falik and I let her tell me what to do next. She said, "File a formal identity theft report with the Federal Trade Commission through Identity Theft, Gov. Do it today." The FTC report creates a dated, official record that you disputed the application as fraudulent. That record is important, not because you need it now, but because if there are subsequent attempts, the pattern is already in the federal record. I filed the FTC report that afternoon. I printed the confirmation and added it to the file I had created for the documented sequence. The file now had 15 entries and 3 supporting documents. Falik also said, "I think it's time to talk about next steps for the marriage." I said, "I know," she said. "Before we do anything, I want a formal business valuation of the LLC on file in my possession. Commissioned and dated before any filing. I engaged 10X Realty and Business Valuations, the same Atlanta-based appraisal and valuation firm I had used 2 years earlier for an LLC review for a formal business valuation. The process took 6 weeks. In October of 2020, the valuation report was completed. The enterprise value of Ajora Financial Consulting LLC, as of the assessment date, was $1,800,000. Falik received the bound report by courier. She filed a copy in her case file. I placed a copy in the Dropbox folder and a printed copy in the hardcover accounting ledger that had replaced my mother's green-lined model, but had never replaced its purpose. It was 11 days after the valuation report was delivered that Gerald Whitmore called me at 12:17 in the morning to tell me that my husband was at the branch door again. I was at Falik's office at 8 the following morning. She had coffee. She had also, by that point, completed a review of the situation that she summarized in 4 sentences. The LLC was unassailable. The joint account had no connection to any business asset. The fraud alert and the FTC report created a documented pattern that preceded any claim by a significant margin. And the midnight visit to the branch was the kind of documented behavior that, in a family court proceeding, characterized a party's conduct in ways that bore directly on equitable outcomes. She said, "He has been trying to find a surface to grip. There is no surface, but I want you to understand that the midnight bank visit is now part of the record, and the record is what the proceeding will be built on." I told Kofi 2 weeks later that I wanted to separate. We were in the kitchen. It was November, and Atlanta in November has the particular dry clarity that comes after the last heat has broken and before the cold establishes itself. I said what I had to say directly. I believed we had arrived at a point of irreconcilable divergence and that continuing to share a household was not productive for either of us. He said nothing for a long time. Then he said, "I want to know what I'm entitled to. Not what happened. Not can we repair this. What am I entitled to?" That question in those words at that moment was the most complete sentence he had spoken in 4 years of marriage. I said, "Your attorney can speak to Falik about that." He left the house that evening and went, by every account I later received, directly to a meeting with an attorney in Buckhead. The legal position that arrived through his attorney 3 weeks later asserted, as its central theory, that Adjora Financial Consulting LLC constituted a marital asset, in whole or in part, by virtue of his domestic and financial contributions during the marriage, including his household income contributions, which had allegedly freed LLC revenues to be reinvested rather than applied to household expenses, as well as what his filing described as his material involvement in the business's professional development during the marriage years. I read the filing twice. Then I called Falik and said, "He's described a marriage I don't have documentation of." She said, "Good, because I have documentation of the marriage that actually happened." The response Falik filed at the first hearing was, structurally, a series of closed doors presented in sequence to a legal theory that had relied on every one of them being open. First door, the LLC predated the marriage by 7 years. The Georgia Secretary of State registration for Adjora Financial Consulting LLC was dated February 2011. The Truist business checking account was opened March 2011. The first client engagement letter was dated April 2011. The wedding was March 2018. These dates were not arguable. They were part of the public record in 2 states, a corporate filing database, and a bank's account history. The LLC was not built during the marriage. It was already operating, fully structured, with 7 years of documented history before the marriage began. Exhibit A, the Secretary of State registration, the Truist account opening documents, and the first 2 client engagement letters, organized chronologically. The second door, not $1 of household income had ever entered the LLC's accounts. The Truist business checking account statements for every month from 2011 through the date of separation showed the account funded exclusively by client payments, ACH transfers, and check deposits from client entities, traceable in every case to the QuickBooks invoice records for those clients. Not one transfer from any personal account. Not one deposit from the Citizens Trust joint account. Not one cash infusion from any source other than LLC client revenue. 114 months of Truist statements. Exhibit B, the third door. The household expense record refuted the claim that his income had freed LLC revenues to reinvest. The Google Sheets household budget, maintained weekly since January of 2016, 2 years before the marriage began, because I had begun tracking expenses when I moved into the house that would become the marital home, showed that household expenses had been covered 64% by my personal distributions from the LLC and 36% by Kofi's contributions to the Citizens Trust joint account. The LLC had been funding the majority of the household from the beginning. His household contribution had not subsidized the LLC. The LLC's distributions had subsidized the household. Exhibit C, the Google Sheets export, 47 months of weekly entries, printed and submitted with a summary table prepared by Brennan and Associates showing average monthly contribution by source across every year of the marriage. The fourth door, the material involvement claim. Falik asked opposing counsel to identify one document, one client communication, one QuickBooks entry, one Buildium record, one payroll record, one lease amendment, one engagement letter, or one operational record of any kind in which Kofi Abiodun's name appeared in a business capacity related to Adjora Financial Consulting LLC. The request for production had been open for 30 days. Opposing counsel produced nothing, because there was nothing. Not one record, across 9 years of the LLC's operating history, showed his involvement in any professional capacity. Exhibit D, the complete QuickBooks client list, the ad payroll history, the Truist account authorized signatories record, and a certification from Priya, the LLC's senior employee, attesting that Kofi Abiodun had never attended a staff meeting, never been introduced to a client, and never been present in the office in any professional capacity during her employment. The fifth door, the midnight bank visit, and everything it represented about the pattern of conduct preceding the legal filing. Falik submitted the Google Sheets log I had been maintaining since November of 2019. Every payment shortfall, every date, every amount, every notation, alongside the written documentation from Gerald Whitmore at Truist Bank describing the 2 branch visits. The FTC identity theft report dated August 2020, the Experian fraud alert confirmation, and the credit monitoring alert showing the attempted loan application. The submission was not characterized as a character argument. It was characterized as a documented behavioral record that established when and how Kofi had begun to identify the LLC as a target and the nature of the steps he had taken to access it. The record predated the divorce filing by 11 months. Exhibit E, the judge reviewed the exhibits across 2 sessions. At the conclusion of the second session, she asked opposing counsel whether the marital asset claim against the LLC would be pursued in light of the documentary record presented. There was a recess of 35 minutes. When the parties returned, opposing counsel indicated that the claim against Ajora Financial Consulting LLC would be withdrawn. The proceeding was restructured around the actual marital assets. The equity in the marital home in Stone Mountain, divided equitably on the basis of documented down payment contributions and mortgage payment history, and the Citizens Trust joint household account balance, divided equally. Both outcomes were fair and both were supported by the documentation record on each side. The LLC was not part of either outcome because the LLC had never been a marital asset. It had been an independently owned, independently operated, independently documented legal entity since 2011, and no amount of midnight bank visits or legal assertions had been able to alter a single line of a 9-year documentary record. The final order was signed in September of 2021. I was in Falake's conference room when her paralegal confirmed the filing. Falake said, "I want you to know, I have handled a significant number of these proceedings. The documentation you kept was not exceptional because it was thorough. It was exceptional because it was ordinary. You kept it the way someone keeps a household. It was never designed to be an argument. It was just accurate. That's what made it unbeatable." I said, "My mother kept a ledger." She said, "I know you've told me that. I think she may have saved you more than she knows." The weeks after the final order were not triumphant. They were the slow recognition that for 22 months I had been operating at a level of sustained dual attention, the business on one track, the legal proceeding on the other, and that both tracks had required everything I had. The business had not suffered. Not one client had any knowledge of the proceeding. Not one deliverable had been late. Not one quarterly reconciliation had missed its Friday completion. I had maintained the operational integrity of the practice with the same daily discipline I had applied to it for a decade, because the practice was what I was protecting, and it had to remain clean throughout. I drove home from Falake's office on a Tuesday afternoon in September and sat in the driveway for a few minutes. Cassius was at the window, as he always is. I brought him inside, and I opened the Dropbox folder, and I looked at the quarterly P&L for Q2 2021, which I had filed 3 days earlier, and which showed annual revenue tracking toward $940,000. The best year in the practice's history, completed while its owner was simultaneously managing a divorce proceeding in a courtroom in Fulton County. I made a note in the Google Sheets budget file, September 14, 2021, final order signed, proceeding closed, LLC intact. Then I closed the laptop and took Cassius for a walk. 6 months after the final order, my mother came to Atlanta for a long weekend. On the Saturday evening, she sat at my kitchen table after dinner and opened her accounting ledger. The same model she had always used, hardcover, green-lined pages, red margin column, though this was at least the 4th volume of it I had seen in my lifetime, and updated her household budget for the month. She did it in pencil, the way she has always done it. Above, below, or equal in the margin, every category, every dollar. She did not make a speech. She did not say anything about the preceding 22 months, the proceeding, the midnight phone call, the 5 exhibits, the 35-minute recess, or any of it. She sat at my table in my house and kept her numbers. When she finished, she looked at me. She said, "The ledger agreed with you." I said, "The ledger always agreed with me." She said, "That's the point." She closed the book. She had more coffee. She drove herself back to Lithonia the following afternoon. That is the moment I returned to. Not the courtroom, not the recess, not Falake's words about what made the documentation unbeatable. The moment at the kitchen table, the pencil on the green-lined page, the 2 words in the margin column, above, below, equal, and the confirmation that the most consequential financial protection I had ever built was not a legal instrument or a corporate structure or a carefully maintained Dropbox archive. It was the daily practice of recording what was actually true, every Sunday without exception, because my mother had taught me that the ledger does not care about excuses, and that the most honest thing you can do for your own future is to make yourself a person it has no reason to disagree with. I want to tell you what I actually learned, because this story has a shape that can be misread as a story about preparation for the worst, and it is not that. It is a story about the consequence of daily accuracy. The first thing is this: clean separation between a business entity and a personal estate is not a divorce strategy. It is the correct way to operate an LLC under any circumstance. An LLC exists as a legal entity separate from its members. That separation has operational, tax, and liability implications entirely independent of any marital situation. The separation I maintained between the Truist business account, the Wells Fargo Reserve account, and my personal Chase account was not a protective measure against a future divorce. It was simply correct practice for an LLC. It happened to be protective because correct practice, maintained consistently over time, produces a documentary record that reflects the truth of the entity's independence. The protection was a byproduct of correctness, not the goal of it. The second thing is about the log. The Google Sheets budget file I had maintained since 2016 was not created as a surveillance instrument. It was a household budget tool, projected, actual, variance, updated every Sunday of the kind I had been keeping in some form since I was 23 years old. The entries I added beginning in November of 2019, when the payment shortfalls began, were not the entries of a person building a legal case. They were the entries of a person who tracks variances. A variance is not an accusation. It is a fact that does not match the projection. You note it. You note when it resolves. You note the explanation given. You maintain the record. Whether the record is ever needed for anything beyond your own operational clarity is not something you decide at the time of the entry. You make the entry because the entry is accurate, and accuracy does not depend on anticipated use. The third thing is about Gerald Whitmore. A branch manager who knows your name, knows your account structure, and has 9 years of relationship history with you is not a formality. He is a human member of your financial infrastructure. He knew the account was solely authorized. He knew my face. He knew when a man arrived at his branch at midnight claiming emergency access that something was wrong and that the right thing to do was to call me. That call gave me hours, and those hours became the time-stamped email to Follick that became part of the documented record. Know your banker, not abstractly, by name, in person, over years. The fourth thing is about the credit bureaus, and it is practical enough that I want to state it plainly. Every person managing independent financial assets, regardless of their marital status, regardless of whether any threat is visible, should place a credit freeze, not merely a fraud alert, with all 3 major bureaus, Experian, TransUnion, and Equifax. A freeze completely prevents new credit from being opened in your name without your explicit temporary lift of the freeze. It is free at all 3 bureaus under federal law. It takes approximately 15 minutes per bureau to complete online. It does not affect your existing credit. You can lift it temporarily when you need to apply for credit yourself, and you can refreeze it immediately after. A fraud alert, which is what I placed in March of 2020, triggers a verification requirement, but does not prevent the application from proceeding if the lender chooses not to follow up. A freeze stops the application entirely. If I had placed a freeze rather than a fraud alert, the August 2020 loan application attempt would not have reached the verification stage. Place the freeze. All 3 bureaus, today. The fifth thing is what my mother gave me, and it is where everything else finds its foundation. The ledger does not care about excuses. It only records what happened. Learn to be the kind of person the ledger has no reason to disagree with. That instruction is not about legal preparation. It is not about anticipating betrayal. It is about integrity applied to numbers, the daily practice of making your recorded financial life an accurate reflection of your actual financial life, so that at any moment to any person who needs to know, the record says what is true. A record that says what is true cannot be successfully argued against. It can only be confirmed. Gerald Whitmore called me at 12:17 in the morning to tell me my husband was at the bank door again. He was there because he had spent months trying to find a surface in my financial structure that he could grip. He had found none because there was none, not because I had hidden it from him. Because I had been building it accurately since 2011, and accuracy, practiced daily over 9 years, produces a structure with no gaps, no ambiguities, and no spaces where a narrative can substitute for a fact. The ledger agreed with me. It had agreed with me for 9 years. It will continue to agree with me for as long as I keep it accurately, which is to say, always on Sundays without exception, the way my mother taught me at a kitchen table in Lithonia, Georgia, with a pencil and a hardcover ledger and 2 words written in the margin column that say everything a financial record ever needs to say. Above, below, equal. Know which one you are. Write it down.